As we started to get to 23 and 2400 and my target was hit, which was 2536 when gold was 1300, I then said, this is not crazy anymore about 5,000, but let's get to 3,000 first. And that's just a round number. There isn't anything specific about it. But it was a number that I felt we were going to get to without ever going below 2,000 again. And then when we get there, kind of address where we could be. Well, we're not that far away from it as we speak. And at the rate we're going here, especially if these shortages continue, we could be there rather quick.
Financial commentator Peter Grandich's earlier prediction of gold reaching $2,536 from $1,300 has been fulfilled in a notable development for precious metals markets. He now sees $3,000 as the next psychological target, with the potential for prices to eventually hit $5,000. He remains confident that gold will stay above $2,000, especially if supply constraints continue. While gold has recently set new record highs during Tuesday's European trading session, some profit-taking has emerged, causing the metal to surrender some of its intraday gains. Nevertheless, prices remain robustly supported above $2,900, reflecting the market's strength. Market observers note that while predicting future gold prices remains challenging, various factors could propel the metal toward the $3,000 mark in the relatively near term. According to Grandich's analysis, the implications for the mining sector are particularly significant. With gold prices potentially trading between $2,800 and $2,900, mining companies are positioned to generate unprecedented free cash flows. This scenario starkly contrasts the broader stock market, where even optimistic forecasts suggest limited earnings growth potential. The relationship between gold prices and mining company profits is notably leveraged. These companies can experience exponential profit increases when gold prices rise, potentially leading to stock price appreciation that outpaces the underlying metal's gains. Looking further ahead, Grandich's longer-term outlook contemplates the possibility of gold exceeding $5,000, particularly in a scenario involving the eventual deterioration of the US dollar. This perspective aligns with historical patterns suggesting that fiat currencies face inherent limitations. The current market dynamics, characterized by strong support above traditional price levels, appear to be setting the stage for what could be a transformative period in precious metals markets and related mining equities. Before we begin, subscribe to our channel and click the bell icon so you never miss an update, informing you about our latest content and insights.
And normally if gold's going to go up a lot, it's usually happening for reasons that may not be as bullish for stocks and bonds. If you think about it, since 2021, it's actually outperformed them since the millennium. But here we are 4 years now since I got out of the equity market to own gold, and it's outperformed both of them, including bonds. And that's unheard of, because when I was a young financial advisor many decades ago, the sales manager would always tell you, listen, if you're worried about the stock market, put them in bonds because they never lose money. Well, bonds lost money the last few years and all. So I don't fully expect the general financial community to ever return to it. What I do expect is that the gold mining companies now are basically going to print cash. Their free cash flow is just going to be records after records. Fourth quarter will be out soon, but now with gold at 2,900, the next couple of quarters, and they'll be one of the few sectors that will probably see dramatic growth in earnings, because the regular stock market is priced to perfection. Even the biggest bulls are not expecting a great increase in earnings. So that will help maybe get some interest from the financial service community, but they're never going to go back and own gold in a big way. They're just not. As we started to get to 23 and 2400 and my target was hit, which was 2536 when gold was 1300, I then said, this is not crazy anymore about 5,000, but let's get to 3,000 first. And that's just a round number. There isn't anything specific about it. But it was a number that I felt we were going to get to without ever going below 2,000 again. And then when we get there, kind of address where we could be. Well, we're not that far away from it as we speak. And at the rate we're going here, especially if these shortages continue, we could be there rather quick. The one thing I'll just say is, and I think you know this from me, is I've never owned it because I want to be able to buy a loaf of bread when nobody else can. I want to keep it right next to my ammo in my log cabin in the woods. I'm not in that camp, and that the whole world's going to fall apart and all. Because even if you have gold, the ones who don't but survive, they're going to try to take it from the people that have it. So I never get into that stuff. I treat it as a capital appreciation potential. It's still an important part of that. And I think one of the philosophy that I have overall to tie this into my overall view is it was pretty okay to be a capital appreciation person for the last 40 years. Markets basically went up other than some sharp, short-term, vicious, but not long-lasting bear markets. I think that's changing, and I think capital preservation now is going to overrule capital appreciation. And therefore, gold will still stay in my opinion, should be part of most people's portfolio. But maybe the percentages that I once had or thought people should have would lower if and when we touch the 3,000. But right now, there's no reason to get concerned. In fact, I personally, and again, I don't want to skip if you were going anywhere, but I actually took some of my physical bullion and sold it so I could buy more junior resource stocks, which is why my hair has receded since we last spoke. But the bottom line is, I don't think there's any major reason to be concerned yet about ownership of gold, as long as you're long, not short.
Peter Grandich has highlighted the strategic importance of gold to BRICS nations, emphasizing their growing recognition of precious metals as a crucial foundation for economic stability. These emerging economic powers increasingly view gold not merely as a trading vehicle, but as a fundamental asset for long-term economic resilience and financial sovereignty. In a significant development, BRICS nations are advancing plans to establish a standard currency system, with gold playing a central role in its valuation. The proposed currency would be uniquely structured, pegged to gold and a basket of BRICS member currencies. While this innovative approach has attracted criticism from various quarters, the initiative represents a bold step toward reshaping the international monetary landscape. The planned implementation would utilize distributed ledger technology as its operational backbone, signaling a merger of traditional gold-backed systems with modern financial technology. The movement aligns with historical patterns of central bank behavior regarding gold reserves. Central banks worldwide have long maintained substantial gold holdings as a cornerstone of their financial reserves, recognizing their effectiveness as a hedge against currency volatility and economic uncertainty. Grandich highlights that central banks' recent surge in gold purchases reflects a strategic long-term view, not short-term trading. This signals a growing consensus that gold will play a key role in the global financial system as nations diversify from traditional reserve currencies to build more resilient economies. Let's get back to the interview.
A couple of years ago, when I became so bullish on gold that I decided to own it versus even stocks or bonds, one of the beliefs was, and I stated back then to you and others, that the shifting of trading of gold from London, New York to Asia is going to kill the paper market, which has basically been manipulated at times and suppressed the gold market, purposely or unpurposely. I'm not here to be conspiracy or whatever. And with that, you would eventually see the physical outweigh the paper market, and then gold could really take off. That was the thesis. And that's basically what's happened in recent days and weeks. For whatever reason, fears of tariffs, actual tariffs, whatever the case may be, the physical market has had such a strong run in recent days that has caused the paper market to really have huge issues. And also people that have to make physical deliveries and all. And that's been innate. But the longer picture, which you touched on, is the real bullish one. So the BRIC nations, which a couple of years ago when I got behind it and aided in me wanting to own gold, and I don't root for it as an American, because if I'm right about it, it's not going to help America. It's going to hurt America. But they basically decided that de-dollarization is here. It's only going to get, not that they needed to create a new currency, because that was always talk that came out of bullion dealers. That was never something that the actual leading countries spoke about. But they needed to look for ways to trade without the dollar and around the U.S. And that really was the idea of the BRICS formation. Well, if you talk to a country now and say, well, let me just tell you this. The United States, first they abandoned their allies, including Canada, when they left Afghanistan. Then in the current Ukraine war, they froze the assets. They were the lead reason to freeze the assets of the Russians. And then they took the interest, which was entitled to be theirs, and give it to their enemy. And now the new guy on the block, meaning Trump, he's basically said, if you don't play with us, he's going to beat you down to the pulp. They're not going to try to get into a wall of words with him, but that's a marketing piece for those that want bricks. And I think it's going to backfire on him speaking that way. Now, he does a lot of these things to position himself, the art of the negotiator and all. But that's a very, very bullish factor. And they recognize that whatever they do eventually in size, they're not going to be able to do it with just a fiat currency. They're going to need something of a real asset, just either between themselves or it ever grows someday to be something that others could be involved in that aren't part of the pack. And that's the reason for the accumulation of gold. Listen, the central banks have not bought all this gold and repatriated for a trade, because who do they trade it to? They're not going to be able to flip it and make that money. So they have bought it on the belief that somewheres down the road, gold is going to play a more important role on how we live. Now, I may be past by the time that comes, but it's coming. The amount of money that majors are going to make with a selling going forward here at 2,800, maybe up to 3,000 out, several months, they're just going to be cash machines for several quarters. And that was important because at the end of the day, they will use their currency, their stock, as their buying power to get new reserves. They're not going to all start grassroots production. They're going to go look at companies, make acquisitions, do strategic deals and all, and that will help the junior market. But the two big things that still anchor the junior market down and have held it back, it's not an excuse, it's a fact of life. I've lost money in these things to understand them. One is crypto. Cryptocurrency has taken the person or persons that might have otherwise went into the junior market 20 or 30 years ago, and they're now in the crypto market. That's where their excitement, that's where their speculation, meme coins. I mean, what's a meme coin? It's like you and I come out tomorrow and say, hey, we started our coin. You want to buy it? And it's just who wants the greater fool theory. There's no value. There's no instant value. I can't use it for anything else. But that's where the hard speculative money has gone. And I don't think it's coming to juniors anytime soon again. The only way it's going to come is that slows down and people start to see how well the majors are doing. And as they go down the food chain and start making acquisitions, and suddenly 50-cent stocks are $2, that'll track it back.
Gold remains a vital asset in the global financial system, valued for its role in reducing reliance on reserve currencies and managing economic risks. Central banks' growing demand highlights its importance in building resilient financial systems and maintaining stability in uncertain times. Do you think gold will keep rising in today's economic climate? Share your thoughts in the comments below. If you enjoyed this video, don't forget to give it a thumbs up and subscribe for more insights into gold and the financial markets. Thanks for watching.